Hey guys, it's Imran here, and today we're going to discuss what we've talked about in the meeting that took place on September 16th, 2019. And for our agenda, we have stocks fundamental analysis, and today we will learn about fundamental analysis. And first, before we get into it, let's review the announcements. So we have please subscribe to the AOF channel if you have not done so already. And this is the third meeting of the year. So a quick recap from our last meeting. So in our last meeting, we learned that key indicators help us make accurate predictions of the market. The open tells us the stock price at 9:30 a.m. of that day. The high and low shows us the stock's highest and lowest price for that day. The market cap signals how much the company is worth. The PE ratio signals overvaluation of a company. The dividend yield shows the amount of money a company pays to its shareholders. Previous close shows you the prior day closing price of the stock. And the 52-week high and low shows you the highest and lowest price of that stock in a year. So that being said, stocks. Part 3, fundamental analysis. So what is fundamental analysis? So a fundamental analysis is a research method in which you analyze economic, industrial, and financial information about a company in order to find out more information about a company. This helps you understand the company's current financial position and thus aid in decision making. Fundamental analysis is an important way of doing research because it teaches you the ins and outs of the company. So when you do fundamental analysis, you're basically looking at, documents that relate to the company, how the economy is doing, and what industry the company is in, and how that's growing over time. So economic factors. So looking at the economy to determine if it's a good time to invest. So one of the main economic factors to look at is interest rates. And interest rates are one of the most important economic factors to pay attention to because they determine how expensive it is to borrow money. And if you think about it, if interest rates go up, then stocks go down because it becomes more expensive for companies to borrow money. Well, if interest rates go down, and stocks will go up. Because why? Because it's going to be less expensive to borrow money since interest rates determine how expensive it is to borrow money. So for industrial factors, you're basically analyzing the growth of the industry a specific company is within. So if you take metals and minerals, for example, and compare it to technology, you'll see that technology is growing at a faster rate than metals and minerals, and thus you would invest in a technology stock. So that being said, fast-growing industries such as tech are more risky but provide high returns. And slow-growing industries such as metals and minerals are less risky but provide lower returns than fast-growing industries. So if you want high risk, high reward, go with tech. Low risk, low reward, you would go with a slow-growing industry such as metals and minerals. So for financial factors, you will analyze the company's finances such as their earnings and balance sheet to know how the company is managing their money. So in the graph we have right here, you can see that for this specific company, their revenue was going up, and their earnings were also going up. So this would be a good company to invest in because it is likely that within the next year, the revenue and earnings would go up. And this helps you understand if the company is growing or declining because you can view their earnings and revenue over the past couple of years. So in this graph right here, we have the past couple of years on the x-axis, and on the y-axis we have the annual revenue and earnings, and you can see it's going up. So that being said, what is a 10K? And when you perform fundamental analysis, you do want to look at specific documents. So one of those documents is called a 10K. So what is it? So a 10K is another name for the annual report of a company. This tells you how much money the company made this year and how the company has performed throughout the year. So this document, in essence, is just telling you how the company performed over the past year. What's the best-selling product? How much revenue are they making? How much profit are they making? And this is beneficial because it will tell you rather, everything you need to know about the company, such as the company's balance sheet and the best-selling products for the company. And the balance sheet basically has the company's earnings and all their expenses in a more in-depth analysis of things. So another document is called the 10Q. So what is a 10Q? So similar to a 10K, a 10Q shows you how much a company has earned over the past quarter, 3 months. And a 10Q also shows you the company's financial situation in comparison to the previous quarter. So when you view this document, actually this is the first page, but when you view the full 90-page document, you can actually see specifically, what the company's balance sheet is like. So how much revenue they made, and you can also see where all their expenses went to, such as research and development and other things. And this is important because it can tell you how the company has performed over the short term, because it's a 3-month thing, right? So this would aid in short-term decision making. So a quick look at fundamental versus technical analysis. So as you can see on the y-axis, we have effectiveness, and on the x-axis, we have time. So this graph right here shows you that how fundamental analysis, right, it's ineffective in the short term, but over the long term, it's most effective. So and that makes sense because when you're looking at company documents, it would make sense that it would be highly effective in the long term rather than in the short term, because it wouldn't really affect how the company performs in the next day or the next month. It would most likely affect it within the next few years or something like that, right? While technical analysis, which is looking at graphs, this proves to be most effective in the short term, and as it goes longer and longer and longer through time, it becomes ineffective right here. So and that makes sense because looking at a graph may aid in your decision in getting in and out of a stock today, but over the long term, it has little to no value. And another thing I want to talk about was revenue versus earnings. And when performing fundamental analysis, it is important to know the difference between revenue and earnings. So as you can see right here, revenue minus expenses equals profit, right? So if a company says they have a revenue of $100,000, that does not mean that they made $100,000 because they have to subtract the expenses. And that being said, revenue represents how much money the company has brought in, while profit represents how much the company has made, which is leftover money after expenses. So profit is basically revenue after expenses, and revenue is basically just how much money the company has brought in. That being said, we did take questions, and it was up to 2 questions per person. And a quick recap. So we now know that fundamental analysis includes analyzing economic, industrial, and financial information about a company in order to find out more information about a company. Economic factors include looking at the economy's condition by analyzing things like interest rates to determine if it is a good time to invest. Analyzing industrial factors includes looking at the growth of the industry a specific company is within. Analyzing the company's finances, such as their earnings and balance sheet, help you know how the company is managing their money. And looking at documents such as 10Ks and 10Qs help you understand how the company works. Thanks for your participation.